In 1929, the year when the economy dramatically collapsed, most Americans were not invested in the stock market at all. Fast forward nearly a century, and today, over half of us are unwittingly gambling our retirement savings on a financial system that has become 6 times more perilous than the one that nearly led to our downfall during the 2008 financial crisis. What I'm about to share with you is not some form of fear-mongering or conspiracy theories. It's math. Cold, hard numbers that starkly reveal why the impending crash won't merely be worse than both 1929 and 2008. It could conceivably be worse than both events combined. I'll guide you through 3 critical components of this elaborate financial puzzle. First, we will examine how our current economic vulnerabilities render the Great Depression look like a minor hiccup. Next, we will delve into what transpired in 2008 and analyze why the so-called fixes implemented since then have only compounded the problems. Finally, we'll connect the dots to comprehend why 2026 could very well be the pivotal year when everything unravels. Let's start with a shocking reality check about historical financial participation. In 1929, only about 3% of Americans owned stocks. When Wall Street imploded that year, most people's life savings were either stored under mattresses or kept safely in local banks. Yes, it hurt when the market crashed, but the overwhelming majority of Americans were not directly exposed to market fluctuations. Many could still grow their own food, repair their belongings, and trade skills to survive. The economic fallout, while brutal, was somewhat disconnected from their day-to-day realities. Now, when we look toward today, we encounter a radically different landscape. Over 58% of Americans now own stocks, either directly or through various means such as retirement accounts, pension funds, and insurance policies. Even if you believe you don't own stocks, you probably do in an indirect manner. Your employer's matching contributions, your insurance company's reserves, and your local government's pension obligations are all interconnected with the market. It seems we have effectively turned the entire middle class into involuntary day traders. This transformation is where the chilling reality begins to set in. The current debt situation surpasses even that of 1929, incredible as that may sound. Back then, total U.S. debt was about 160% of GDP. Today, it has skyrocketed to approximately 350%. And I'm not just referring to government debt in this calculation. Think about student loans, credit cards, mortgages, auto loans, and even that treadmill you bought that's now gathering dust in your garage. The average American today carries more debt than most individuals made in 2 years back in 1929. We are no longer living paycheck to paycheck. We are existing from loan payment to loan payment, caught in an endless cycle of financial obligation. Consider the staggering fact that the interest on government debt alone now exceeds $1 trillion annually. This amount is greater than what we spend on national defense as a nation. We are literally devoting more resources to service old debt than to protect our country. It's like finding yourself so entrenched in credit card debt that the minimum payments are higher than your rent. We also need to discuss what I term the everything bubble. Back in 2008, we had one primary asset class experiencing wild inflation: housing. Today, we are facing a bizarre situation where there are simultaneous bubbles in stocks, real estate, bonds, cryptocurrency, and even private equity. The market's price-to-earnings ratio has reached levels we have only witnessed twice before in history, right before the dot-com crash and just before the catastrophic events of 1929. After witnessing the crisis in 2008, it seems we collectively decided to repeat the same mistakes, but now we're juggling these issues across the entire financial spectrum. Let's take a moment to understand how we got here in the first place. The crisis of 2008 originated from a seemingly straightforward lie: why rent when you can own? After the dot-com bubble burst in 2000, the Federal Reserve slashed interest rates to almost zero. Consequently, money became cheap, borrowing became appealing, and suddenly, buying homes became America's favorite pastime, eclipsing baseball. Banks began approving individuals for mortgages with what came to be known as ninja loans. No income, no job, no assets, no problem. Part-time workers at fast food restaurants were being approved for luxury condos, and people were purchasing houses as if they were simply ordering a cup of coffee. The prevailing assumption was simple and seemingly bulletproof. Housing prices would always go up, and the idea went unchallenged. The lesson from both 1929 and 2008 is that the next crisis never looks like the last one. It starts with something that seems harmless, profitable, and inevitable until suddenly it isn't. Right now, we're juggling chainsaws while riding a unicycle on a tightrope, and everyone's betting their life savings that nothing will go wrong. Now, I'm not saying sell everything and move to a cabin in the mountains, but maybe, just maybe, don't have 100% of your financial future tied to assets that are all connected to the same increasingly unstable system. The 1929 crash destroyed wealth. The 2008 crash nearly destroyed the financial system. The 2026 crash might destroy our entire concept of what wealth even means. If this analysis opened your eyes to risks you hadn't considered, make sure to subscribe for more deep dives into the economic realities they don't want you to understand. The numbers don't lie, even when everyone else does.